I'm just going to run into our so-called model portfolio very quickly. So we have a model portfolio. We call it absolute 10, not because of the vodka, but it's mainly for you to generate absolute return. If you relative returns is for for fund managers, but for us, we want to generate real returns for investors, and not relative returns that you can't they can't pay any bills. We just earn relative returns. But anyway, this is our model portfolio. We took out Ascenders REITs and Capital Land Investment. We took out Ascenders REITs because we are trying to add more cyclicality, more beta into our portfolio. Capital Land Investments is purely because of the strong return. So the new ones we added was HRnet, which we will elaborate later. And we also added City Development, which Natalie will elaborate later. So in terms of the performance, we did improve a little bit after suffering from our YOMA exposure here. But in a nutshell, for third quarter, it was like money for nothing because we outperformed, but we didn't generate much return. It was still a negative 1% for a summary. What pulled us down in the third quarter was mainly the reopening names like Ascott, ComfortDelgro, because of the reimposition of tighter controls. That kind of hurt the sentiment on these both stocks, which we will elaborate why we still like them. Sorry for rushing. So let us move on to DBS. Hand it over to you, Glenn.
Thanks, Paul. So our pick for the banks would be DBS, and the theme is interest rates tailwinds. So for DBS, they have excess deposits of around 59 billion. And if you look at the chart on the left, it shows the DBS quarterly NIM against the quarterly 3-month SIBOR. And we can see that they are quite closely related. So with every rise in the interest rates, the bank's NIM will also follow suit. Therefore, if interest rates are to rise, we can expect that DBS would benefit as they have this large excess deposits of 59 billion and they can use that. And hence, we expect the NIM to also increase. So for full year 2021, we expect the NIM to be 1.47%, and for 2022, 1.48%. And this boost in earnings actually came from an increase in fees and commissions, which rose 27% year on year, which was led by a strong growth in the wealth management fees, which grew 31% year on year. With an improving economy, the fees and commissions are expected to grow, and we expect a growth of about 15% for full year 2021 and a growth of 10% for 2022. Also to touch upon, the bank's AUM has actually increased by 14% year on year for first half 2021 to about 285 billion, and we expect this growth to continue. There was also broad-based loan growth of about 3% in 2Q21 and a growth of 6% in first half 21. This growth was mainly led by the trade and non-corporate loans. We also expect this to continue, and we expect loan growth of about 4.4% for full year 2021 and a growth of about 5% for 2022. And with asset quality stable, DBS was able to further write back general provisions of about 85 million in first half 2021. In light of this, we have lowered total provisions for full year 2021 to 309 million from 772 million. With the lifting of the dividend cap by MAS and the return to this pre-pandemic dividend payout, we also expect dividend yield to improve to 4.5% for full year 2021 and to 5.1% for 2022. The CET1 for full year 2021 is expected to be 14.2%, which is actually still above the bank's optimal ratio of about 12.5 to 3.5%, 12.5 to 13.5%, and this high CET1 ratio could pave the way for an increased dividend payout. So that's all for me. I'll now hand over the time to Vivian.
Thank you, Glenn. First of all, I'll be covering LHN, which offers flexible, affordable, and adaptable spaces. So basically, what they do is that they will secure the master leases or acquire properties through joint ventures for these underutilized properties and revamp them according to the latest trends, and I'll be explaining a bit more on that later on. So for example, first of all, under industrial properties, they offer work plus store outlets. The picture on the top left is an example of the newest work plus store outlet that they just recently launched a few months ago. At this work plus store outlets, they are seeing full occupancy and 70% is occupied by e-commerce tenants. So we could attribute this high demand to the online retail sales, the surge in the online retail sales. So you can see that the year-to-date online retail sales was up 21%. And this is mainly due to the pandemic, as more people are purchasing goods online. So other than the high demand, Walk Plus Store also offers flexible lease terms and flexible upgrading of storage spaces. And if you want to start an online business, it can be said to be the most affordable option compared to renting an entire industrial space or a whole storefront. So for these e-commerce retailers, what they offer is that they have photography studios to hold Facebook Live and Instagram Live sessions to engage with your customers other than the storage spaces. And recently, they have been also adding more value-added services, and that includes delivery and car sharing services at their properties. And just to mention that the recent launch in the picture, this Walk Plus Store, is the biggest outlet to date in their portfolio. So next will be residential properties under which they operate the co-living spaces under Koda. So similarly, they are also seeing full occupancy. And interestingly, there is an increasing demand from the locals, also due to the pandemic, as more people are preferring their own living and working spaces. And for FY22, we are expecting about an addition of 200 keys, and this represents an increase of 25%. So similarly, Koda also offers flexible lease terms of a minimum of 7 days and affordable rents that depends on the location and the room type. And in the picture on the bottom, at the bottom, you can see that this is an example of a room that they offer at the Koda property at the Keppel Road. Yeah, so that's all for LHN. Next, moving on to Koda. Koda is a manufacturer of wood-based home furniture for the living, dining, and bedroom. And for FY21 revenue, US made up of about 60% of revenue. So they are riding on this furniture boom in the US mainly due to the prolonged work from home and study from home trends, as more people are staying at home and realize that they want to change out of their old furniture and purchase new furniture. So in the chart on your left, you can see that the value of the US furniture imports has remained above pre-COVID levels, as highlighted by the blue bars, even though the year-on-year change, the percentage change as represented by the red line has slightly declined. So as we can see, the demand is very strong, but on the production side, there have been some disruptions in the factories in Malaysia and Vietnam due to the pandemic restrictions. So they have since resumed Malaysia operations at full capacity since early September. And a few days ago, they announced the resumption at 50% capacity on the Vietnam side. And given the rate of resumption, which depends on the ramping up of the vaccination rates, I think it's reasonable to say that we can think that they will be able to resume at 100% capacity before the end of this year. And lastly, Koda is also expanding into manufacturing sofas. So this is the last stock catalyst for them. So we have a buy rating with a target price of $1.10. And that's all for me. I'll now be passing the time on to Natalie.
Hi, thank you, Vivian. So now moving on to Ascott Residence Trust. For Ascott, first of all, we like Ascott because of the diversification in terms of lease type and geography, which provides some stability. Okay, so in the graph on the left-hand side, this is how the gross profit breakdown looks like. So master leases and the MCMGI, which stands for minimum management contract with minimum guaranteed income. These two are the stable leases that you know, as you can see in FY20, while the hospitality sector actually took a hit, this master leases and MCMGI actually came in quite strongly and helped the Ascott portfolio. Okay, so moving in onto when we start recovering, we expect that the management contract will start to pull its share of the weight, and for the master leases and MCMGI, of course, it will drop relatively significantly. Okay. Second of all, of course, we expect a potentially faster recovery for Ascott compared to their peers because of this diversification. 69% of assets are actually in countries with large domestic markets. So while international borders still remain largely closed, the domestic travel restrictions have been eased, and that also, of course, allows some travel for domestically. Again, some of these domestic countries that they are in with large domestic markets include France, Australia, US, UK, Japan as well. Okay, so third of all, Ascott targets to increase its long stay portfolio of PBSAs, student accommodation assets, as well as rental housing assets to 15 to 20% in the near term. Currently, they are at about 11% after picking up 2 more assets this year. Okay, and as mentioned earlier, these type of long stay asset classes, they maintain high occupancies of above 95% throughout the cycles. Last of all, of course, is Ascott's ability to recycle assets and realize capital gains. So some of the assets that they have sold over the last 5 years, we see that they have exited at yields of about 2 to 5%, and they have actually reinvested these proceeds into higher yielding assets that yield about 4 to 6.5%. Okay. So overall, we have an accumulate rating on Ascott with a target price of $1.19. This translates to a still recovering DPU yield of about 4.7% for FY21. Moving on to the next counter, which is Frasers Centrepoint Trust. For FCT, they own a portfolio of suburban malls, and these suburban malls have been resilient through the cycles. This, of course, is due to the proximity to households that lead to recurring necessity-driven spending, groceries, F&B services, hairdressing, and etc. Okay. And these necessity sectors actually contribute about 54% of gross rental income, GRI for short. Okay. And overall, if you look on the left-hand side of the where the chart is, you can see that FCT actually sustained recovery above the general market, which is the red line that towers over the blue line, which is the average RSI excluding motor vehicles. Yeah. Okay. In terms of our second investment thesis, we see that the demand for space at suburban malls is likely to remain strong due to the captive population, and not to mention that while some of the central malls have actually resorted to decreasing their base rents and increasing the amount of gross turnover variable rents. Some majority of the permanent leases signed by FCT, the tenants have actually opted to have the traditional lease types, which means that your regular, slightly larger component of fixed rents and a smaller percent of gross turnover rents. And we think that this actually indicates that tenants are more optimistic and confident about maintaining and growing their sales. Hence, they're opting out of this kind of risk sharing, profit sharing kind of models. Okay, so for FCT, we have a buy call, $2.79 target price, and that translates to a DPU yield of 5.4%. Moving on to the last counter for me, that is City Developments Limited, CDL for short. For CDL, we have three investment theses. First of all, currently Singapore is experiencing a relatively strong property upcycle. CDL has recently replenished its land banks, and the number of units in the pipeline stands at 1,746 units for CDL alone. So it means this is just CDL's stake of the units. This will translate to a gross development value (GDV) of 2.1 billion in FY22 and 1 billion in FY23 for the Singapore segment itself. And not to mention some of the recent redevelopment projects that they are doing, Fuji Xerox, as well as the joint venture with Capital Land, which is Canning Hill Pierce at Clarke Quay. These assets actually, the entry price or the land bank price is actually relatively low because the land was actually acquired. It's either Fuji Xerox was a legacy asset that they have held on the books for a very long time, and for the Clarke Quay property land area, that was because they managed to get the asset on off-market deals. So that result for these two projects specifically, we're actually forecasting margins of above 30%. So that will, of course, help with the profitability and profit margins. Second of all, the impending recovery of the hospitality sector. So the hospitality sector actually contributes about 15% of EBITDA for CDL. And of course, it was pretty much affected in FY22 in FY20 during the pandemic year. So the impending recovery of the hospitality sector will, of course, help to lift revenues. And we're actually projecting, we're more conservative in terms of our projections. We're projecting a 20% revenue CAGR for FY21 to FY25. And we're expecting this segment to turn NPI positive somewhere around FY24. Our third investment thesis is the asset monetization. So this mainly, the most impending and the one that's coming the soonest, of course, is the listing of the UK commercial REIT. So CDL has, already made applications to list this REIT. They will be a co-sponsor. So assuming a 20% stake, 15 to 20% stake in this REIT, and assuming a gearing of about 38%. So we think that this will actually, CDL will inject two assets into the REIT, Aldgate House as well as Old Broad Street, 1250 Old Broad Street. And this will actually allow them to realize, unlock about $526 to $633 million, allowing them, of course, to replenish their dry powder and make more investments. Last of all, of course, just want to point out that CDL is actually trading 50% below our RNAV per share of $14.14. Okay, and we think that this is a very compelling value proposition. So that pretty much sums up my stock pick on CDL. I'll now pass the time back to Paul.
Thanks, Natalie. So don't worry, everyone. We are at the final stretch, so it's almost more than 1.5 hours, probably longer than watching a soccer match. But please bear with us. Just a few more slides. So for Keppel Corp, we still have a buy. Essentially, the investment team for Keppel Corp is just demerging. That means they are going to sell non-core assets, and they're going to, which is namely the merger with SembMarine. That means disposing it. Number one. Number two is also disposing some of the assets, the Set Brazil. We call them the stuckiest assets because they were stuck with it. So that's the disposal of that. So there's another catalyst. And the third catalyst is that if the deal with SPH goes through, because there's a lot of synergies, a lot of value and monetization aspects of it. Because if they do acquire SPH, the bulk of the assets, the two main assets in SPH will be the PBSA, which is student dorm, which can be listed almost immediately. And the second thing is also in SPH, there's this huge data center, which can be also which there's a lot of value that can be created out of it, because once you fit it up, you have tenanted it out, and then you can just sell it back to Keppel DC at multiple at times higher than your book value. Of course, the thing is whether SPH minority shareholders want to release, want to accept the offer. And with all this demerger, in conclusion, with all this demerger and of the loss-making assets, what we hope is that they can hit their 15% target ROE, compared to the pathetic ROE that they were getting the last 2 years, which is of course unfairly dragged down by the REIT business. So that is the main driver. That's the main thesis behind Keppel Corp. Our analyst Terence couldn't be here, but this is basically the rationale for Keppel Corp. I'll move on to just 3 more names. So ComfortDelgro, why we still have it. I'm probably repeating this for the 3rd time, so hopefully this time the share price really turns around. And the reason why we think is that the turnaround is, firstly, despite the pandemic being the worst ever, their balance sheet actually improved. They used to be, I think, 200 million net cash, but with the pandemic, actually the net cash rose to 500 million. And there's a lot of operating leverage when it recovers. Sorry, there's a typo here. The next catalyst for the share price is the downtown line. So even before the pandemic happened, downtown line was losing maybe almost 40 million plus. And that was even when they had 1 million passengers. So you can imagine now that it has dropped to 800,000 passengers. The losses is just widened even further, because now this is huge leverage. The cost is all fixed. So we think there is going to be a restructuring of downtown line. Like all the other all the other MRT lines are under the NRFF1, which only downtown line is not. So they are the ones, and so we think there will be a restructuring whereby the risk, that means the fair risk, is shared with the authorities. Because right now, if there are 1 passenger less, is all borne by downtown line. So we think there'll be risk sharing whereby any upside will be kept, downside will also be kept. So this will be the other trigger. Of course, for us, our buy call on ComfortDelgro is just a recovery and a re-rating because of some of these events. I mean, we have no illusions. We know Grab is a formidable competitor, but pre-pandemic, this stock was trading about 250. Right now it's 150. So we just buying into the big recovery when things normalize and some of the one-off restructuring events that can now re-rate the share price. In terms of this is going to be our last one. Second last one, which is HRNet. So we seldom use the word gem, but this is really one of the very rare companies we find is a gem because of the metrics. So if you look at this company, firstly, HRNet is the largest recruiter in flexible and permanent hires in the region. Secondly, why we say ROE is 100%, because their capital is 300 million and they got a net cash, which, in a way is 300 million. So virtually they can pay all the capital back to shareholders. And also to run this business, the fixed assets is, it's actually not one, it's actually not two, actually it's more like 1 million plus. So very rare you get a company that only needs 1 million fixed assets, which is basically like maybe 20 laptops, 20 desktop and 5 printers, and they can make 70 million dollars a year, 70 million Sing dollars a year. And that's because we think they are a formidable competitor. I mean, it's easy to set up a headhunting organization, but to have the scale and track record, that's where their strength is. Because only the large corporates will only want to see the largest, because you got they got a couple of hundred recruiters there, and they got a track record of meeting all the needs of their clients, especially nowadays when the requirements are a bit more niche, like AI roles and so forth. And of course, that is one thing, but the thing we think can lift the share price is there's an upswing in hiring. So if you look at this chart here, this is the Singapore vacancy. One way you can read it is that for every 163 jobs, for every 163 vacancies, that means jobs out there, there's only 100 available. There's only 100, compared to the amount of people unemployed is 100. So there's more jobs, there are more vacancies than jobs out there. And if you want to look at the PMATs, it means these are manageable levels. The vacancies out there are at record highs. So that's why we think there's going to be an upswing in volume, and there's also going to be an upswing in salary. So as you know, in this business, you're paid like 15-20% or more of the annual salary. Now that the vacancies are up, salaries are also rising. So you're going to get a benefit of the volume, and you're also going to get a benefit of the higher salaries. We've already seen that in the first half, the earnings is up 70%. Our rating is a buy at target price of 105. So sorry, I'm rushing this again. So for Q&M, we still have a buy. They're the largest dental chain. The first half, second quarter profit was up 23%. We think the third quarter should still trend high. If you look at the chart here, so these are the industry. That means the number of people like us not going to dentists, hopefully for just basic checkup, but if you for us at least. So you can see that in 2021, the growth rate is still higher than 2020. The trick now is whether can they go above the pre-pandemic levels. But at least we know for the third quarter, July, August, is still going to be a good quarter for them in terms of dental. And the most important for us is the number of clinics is growing. So even though volumes are flat, what we're hoping for is that they continue to grow the number of clinics by 20% CAGR, and that will help support the earnings growth. The share price took a bit of a hit because we were valuing quite high wrongly, obviously. We were valuing their PCR business about maybe almost 15-18 times. But right now, with the going to endemic stage, obviously the valuations have to narrow. And with the recent acquisition by the associates, I think the valuation can now go down to less than 10 times. So that's why the share price took a bit of a hit, because now people have to kind of derate a bit of their COVID-19 PCR tests.